Hey guys, Doug the Retirement Guy here. Got an educational video for you. How does return of capital, ROC, work? So we're going to talk to you about the advantages, disadvantages, and what do I need to do in the whole process. There's been a lot of questions because so many ETFs have been switching over to ROC, return of capital, and so many of you seem to be confused onto it and asked us to help you out and do some videos with it. So we'll get into it today. So this video is brought to you by our Patreon supporters. Without them, we could not do these shows. They do it by supporting the channel. If you want to be a supporter of the channel, it's simple and easy to do. Go down to the description, hit that support the channel button, and sign up as a member. There's a lot of information behind the scenes that you can get, and it's free to start, and then you can take it how much you want to support the channel. Also want to thank each and every one of those new subscribers are out there. This is the stuff that you're not going to miss. We have videos like this all the time. And all of our past subscribers, thank you for your support. Let's get into today's video. Notice to all videos, past performance does not guarantee future results. The information provided in this video is educational and informational purposes only. It should not be considered financial or investment advice. The examples and suggestions discussed are illustrative and may not be suitable for all individual situations. Always consult a licensed financial advisor and a professional for making financial decisions. So let's first off explain a little thing here that we're going to start with. It's called dividends that we got to explain. There are two really types of dividends that we deal with. The first ones are qualified dividends, and the definition and tax treatment of those dividends is that they meet the IRS criteria, allowing them to be taxed at a lower long-term capital gains, which is anywhere from 0 to 15 or 20%, depending on your income level. So this is an area that you'll see a lot of funds, stock funds, ETFs, mutual funds will try to get qualified so that they can be a qualified dividend. So when you look at your statements from your brokerage, you'll see qualified and then another side that says non-qualified, which are just ordinary dividends. Those dividends don't meet the IRS criteria for qualifications and are taxed at the ordinary income rates, which in 25 range between 10% to 37%. So that gives you an idea of what, when you see dividends come across, qualified and non-qualified. Now, one thing that a lot of people misplace when we get into the ROC is it's not really a dividend. They're actually called distributions. And there's a reason and an explanation of why we call them distributions. So IRC is a payment of your original investment, not earnings. Okay, it represents a return of your principal, not dividends or income. This is why they're called distributions, that they're distributing back your initial investment. So they're not classified as taxable income. So why do funds use ROC? Well, first off, it's smoothing the distributions. The funds, especially ETF, closed-end funds, and covered strategies, might include ROC and distributions as a main stay for basically steadying the payments out of actual income or gains when they're inefficient. So a lot to be said there. I'll explain it to you in my terms. Basically, a fund can continue to put out an equal amount of distributions. We'll take ULTY that pays out that 9.5 to 10 cents almost every single week with no questions asked. Well, they use ROC all the time, and that means this allows them to continue to pay that even when they don't achieve those numbers in profitability. The tax efficiency of ROC, it's not taxed upon receipt. Unlike dividends or interest income, instead it reduces your cost basis, deferring taxes until you sell your shares. Okay, so this is really, you're not paying any taxes until you decide to sell your shares or you end up zeroing out your cost basis. So there's an advantage on both sides for the ETF, so they can have a standard distribution, which makes everyone want to invest. And then there's a tax efficiency that is a benefit for you. So how does ROCs affect the investor? Well, it's kind of simple. It lowers your cost basis, which is the potential for bigger gains later. If you receive your ROC, the cost basis decreases, meaning you actually and eventually will sell for capital gains. So when calculated is larger. Okay, so hopefully the fund is going up in value. You have no cost to it. That's when you're going to be basically paying your taxes onto it is for that on a bigger portion. Now, not immediately as taxable because ROC is an income. It's not taxed and it's not paid every year. This is another big factor to it is watch the destruction of ROC. If the distributions exceed a fund's earnings, it will chip away from the NAV. And this is what we actually are hardcore true NAV erosion. This may indicate unsuitable payouts that erode the future returns. So this is your first warning sign. If you've seen us do other videos, when you see funds that the assets under management are starting to be reduced, we immediately say, whoa, 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 stop. Is this an ROC? Are they taking money literally out of their pocket to pay back their dividends or their distributions? And you have to know that is this a short-term or a long-term issue? And that's why we have to always watch these things. So really, let's get into and explain ROC on, I always call this and don't take an offense to it, but I call it, let's do it as a fifth grader would do it. You have an ETF fund that you're purchasing, and you're going to purchase $10 a share, so you're going to buy 100 shares. So we're going to put this as your total investment is $1,000 into this ETF fund. Now, the nice thing about it is that this fund has a distribution of $1 per share. And they pay it out in an 80% return of capital, ROC, and 20% income. Now, why would we have income into this? Well, there's multiple different reasons. And if a fund is doing things into treasury notes or trying to collect interest in different ways, there's so many different funds out there. YMAX is a great one. MSTY has it. There's so many of them have funds that are out there that have interest bearing. So they have to do that as income, and the rest of it is return on capital. So let's first start with the easy one, income first. I think everyone will gather this very simply, and that is in the 80-20 program, 20% is income. So 20 cents a share comes to you as income. So you're paying $1 of distributions. 20% of the dollar is 20 cents. That gives you an income of $20 from your 100 shares. Those will go to you as non-qualified ordinary dividends. And that is the definition and the tax treatment of it. Dividends that don't meet that IRS criteria for qualification are taxed at ordinary income rates, which in 2025 is 10 to 37%. Okay, so on an 80-20 distribution, you're only paying 10 to 37% on that $20 that you received. Kind of simple, very easy, basic to understand. Now let's talk about the ROC side of it. 80% return of capital, ROC, means 80 cents a share is return capital. So 100 shares that you bought, paying you $1 in dividends, 80% of 100 is 80 cents, times your 100 shares is $80. Now what takes is your initial investment was $1,000. It will be reduced by the $80 down to $920. So it's just basically giving you your money back. So your initial investment of $1,000, your distribution of $80, your new cost of the 100 shares technically is now $920. So now that's your money being returned, so there's no taxes due onto it. Now, I want to stop right here and make sure everyone understands. I'm looking at this fund saying it's never growing. It's staying at the price. You have an investment worth $1,000. But now, because you've got $80 back, you really have only $920 invested into it. So on books, gross, you have $100,000. Net is $920. Now, what happens when my investment gets to zero? When your investment gets to zero, which we'll explain here is the initial investment of $1,000. In our scenario here, 13 months of distributions gives you $1,040 of cash input. Your new cost of those 100 shares is now zero, and you have a cash distribution is now $40. So the ROC distributions are taxed at capital gains. So after your cost reaches zero, any additional ROC distributions are treated as capital gains for tax purposes. This means they are reported as taxable capital gains in the year that they're received. Even though they're still called ROC, they are still classified as capital gains taxable. Now, what does that mean to you? Well, how long have you held this fund? If you've held it over 12 months, or excuse me, if you held it for less than 12 months, you are going to get short-term capital gains, which again goes back to that 10 to 37%, which is just basically like regular income. But if you hold this for over 12 months, which as in our scenario here, you're saying we're holding it for 13, you become long-term capital gains, which are anywhere from 0 to 15 or 20%, depending on your income level. So this is primes definitely when you get into the retirement thing, when you're starting to use less income, less setup of that way, you can pay less in taxes using the ROC system. And this is how it works out. So that $40, for me personally, I would have held it for that 13 months. I'd probably be in that 15% category of income level versus paying something in the 20 to 25% range. And that is for every distribution that we get on this fund from here on out are going to be taxed into this program. So what happens when I sell my shares? Well, basically the same thing is going to happen when you sell your shares. So the initial investment you had was $1,000. Your distribution amount was $400. So I'm going to say we're going through this, and 10 months down the road, I decide I'm cashing out. This ain't doing it worthwhile. It ain't growing. Nothing's happening. I'm going to cash it out. Well, the IRS, your distribution center, will look and say, you received $400 of your initial money back. So your fund and cost is now $600. So when you turn around and sell this fund for the $1,000 that it's really worth, they are now looking at you and saying, well, you have profits of $400 and are taxed at capital gains. So based on how long you've had the fund, if it's less than a year, you pay short term. If it's over a year, you pay long term. So in this scenario I'm giving you, I sold it in only 10 months. So it's actually a short-term gain. This is why we continuously tell people is you got to have a plan. You got to know what you're going to do when you buy these shares. What is your plan? I buy things with ROC for long term. When you take, like, it's simple, a ULTY, and they're using ROC, I expect to set it and forget it and let it sit there, collect the funds, the distributions from it, put that money to replace the initial investment, and I will only be paying the big tax bill on the initial investment when I decide to sell those funds. I may never decide to sell those funds. I'll pay the distribution on the capital gains on the distribution, but I probably will never sell those funds and never have to worry about this until I'm many, many years down the road. But in this scenario, if we paid it off and sold in only 10 months, we would pay that short-term capital gains rate anywhere between 10 to 37%. But if I hold it long term, I'm going to pay anywhere from 0 to 15 or 20%, depending on my income level. The older I get, the less income I'm going to have, the lower taxes I'm going to pay. Very similar to what they do in a 401k or a Roth type thing, is that they're using the tax rules in the benefit for yourself. So how does a ROC affect the investors? Well, it lowers your cost basis potential for bigger, larger gains. How is that? Basically, what we're doing is we're setting capital gains are calculated when the fund is normally larger. If this fund grows and grows and grows, so take our example, if our $1,000 turned into $2,000, I'm not paying capital gains until I sell it. Okay, so I'm getting capital gains on that larger amount, but I've been profiting from it over the past years when they give every distribution. It's not immediately taxable. ROC isn't income. It's not taxed in the year that it's paid until you hit zero. And then this is a big one that people miss out on is I get to watch and see how's a fund doing just from ROC. Is this taking away the NAV? Is this taking away the value? Normally, the assets under management. When a fund stops issuing more and more stock and more shares, and then we watch the unit of the UAM or AUM, the assets under management start dropping, well, we're seeing massive NAV loss, and all of a sudden we know this fund is starting to erode, and we don't know what's going to happen down the road. So the benefits of ROC, it's tax deferred. You delay your taxes on ROC until you sell, often at a potentially favorable long-term capital gains. Okay, and that's the whole key. Get it to long-term capital gains, and you're guaranteed to save money on your taxes. Estate planning and advantages. ROC lowers your cost basis, but upon you passing, the heirs typically receive a step up in the basis to current market value. Okay, so you can plan your estate down the road. I don't want anyone to pass away. I don't want anyone to retire to the big blue sky, but we have to plan for it accordingly. And it's also flexible cash flow. ROC gives investors monthly or quarterly income without requiring them to sell shares. And this is the positive to it. This is why we invest in these packages and these funds, is because we want the cash flow. But we don't want to worry about our tax side of it. So that's why I always say, when you're going to buy a big enough lot that you're going to get 12 months worth of cash flow. So many things ties our videos together where you'll see the return on investment and the assets under management and how long a fund's been out there, what is it paying, and how is it doing. These are all the benefits of ROC. That's why we look for these so much. So a quick summary. What is it? It's a distribution of your original investment and not income. And remember, I know I will say it numerous times in other videos, I will turn to you and say, "Oh, this is a dividend." No, they're distributions. Tax treatment. They're not taxed when you receive. It reduces your costs down the road. The benefit defers the taxes. It smooths out your income. It may provide estate planning advantages. The risk is the repeated ROC distributions that eat into NAV. And it may be unsuitable and may be harm for long-term fund performance. That's why we're constantly watching it for you, and we tell you to watch it. How to judge? Compare distributions to NAV changes. If your NAV doesn't fall enough to justify the ROC, it may be constructive. If it does, it may be destructive. Okay, if you find that every time they pay that fund out and you see that the NAV is going down, it's maybe time to be out of that fund. So my final thoughts: capital gains, guys, can be a smart strategy for generating tax efficient income, commonly employed by ETFs like ULT, ULTY. PLTY does it as well. That's the target of distributions, and they may do it from options premiums or other income ways. However, it's virtual to monitor whether distributions are economically supported or pure eroding of the principal. When I first looked at this, I thought return of capital was, man, they're just giving me my money back and this is a fraud. And then I've done the research, and you can see that we've done heavy research to find out that this is a tax advantage for you and your family. But we've given you a lot of different ways to monitor it and make sure that it's right and safe for you. Guys, it's Doug the Retirement Guy. I hope you like this information. I hope you guys give it a thumbs up. If you're not a subscriber, this is what you're missing. We're not just talking about stocks and funds and income and all this. We're talking about how to establish yourself in the long run. So hit that subscribe button. If you guys liked it, leave a comment. If you didn't like it, leave a comment. We always love to hear from you guys.